Hello and welcome to Payden and Regal's 2020 Municipal webcast, Doing Well by Doing Good, Impact Investing with Municipal Bonds. Thank you for joining us today. My name is Maurice Salwan, National Accounts and RIA Advisor Consultant serving the West. For your convenience, we have listed your Payden team members' contact information at the conclusion of the webcast. Before we begin, a few housekeeping items. You have access to the Zoom Q&A capability at the bottom of the Zoom window where you can submit questions. And we have dedicated time at the close of the presentation for a Q&A session to address these questions. This is part of our larger Payden webcast series, and we will continue to notify you of future presentations. A final note, this webcast will be recorded and the presentation will be available on the Payden site. Payden is a long-standing signatory of the UN-supported Principles for Responsible Investment, having signed in 2013 and an active participant in various standard-setting working groups. Each year, signatories of the UN PRI must report on their responsible investment activities. The PRI independently reviews submissions and issues an assessment report. We are pleased to share that for the reporting period ending March 31st, 2020, Payden and Regal received the highest score of A+ across all graded modules. We are also Sustainability Accounting Standards Board Alliance members, otherwise known as SASB, working to actively integrate SASB 77 industry-specific standards into our corporate investment process. Also in 2020, Payden continues to lead the investment management industry on climate issues by achieving carbon neutrality through annual carbon audits and offsets. Across the firm for ESG mandate-oriented clients, Payden has over $800 million invested in cross-sector green labeled product. Anticipating the growing demand for mission-oriented investments, we have a dedicated impact strategy that focuses on the U.S. municipal sector. The Payden California Municipal Social Impact Fund has committed to investing at least 80% of its total assets in California municipal securities or other municipal securities that we believe are consistent with positive social impact practices and outcomes. I'm pleased to introduce our speakers today, Ksenia Kobin, Vice President, Adam Condon, Senior Vice President, and Christian Levesque, Vice President. With that, I'd like to welcome our first speaker, Adam Condon. Adam, over to you.
Thank you, Maurice, and good morning to some and afternoon to others. And thank you all for joining us today. We hope to accomplish three things for you today. First, I'm going to provide a foundation for why we think municipals remain an attractive core investment for high net worth individuals. Next, Ksenia will introduce the concept of impact investing through municipals, outlining how we think about impact investing and walking you through the proprietary framework that we've created to both quantify and measure specific municipal investments and their impact characteristics. And finally, Christian will discuss the implementation of that framework into portfolio construction using the Payden California Municipal Impact Fund as a live example. By now, we're all painfully aware of how challenging the current environment is. We have inflated asset prices across the board, yields across the fixed income universe are at or near all-time lows, equities are back to all-time highs, all while we're still trying to sort out the haves and have-nots of this global economic slowdown and trying to both estimate the impact and quantify the impact of unprecedented global stimulus. So I know that's a little bit of doom and gloom, but the obvious question then is, well, where do you go from here? And in this type of environment, our focus is simple. Determine where we can source the most efficient, attractive, risk-adjusted income for our clients. And based on our evaluation, we find that municipal bonds should continue to serve as the core foundation for high net worth individual portfolios, serving as the Northern Star, if you will, as we navigate the marketplace. This observation is founded on three primary pillars that have served municipals well historically, and we expect will continue to do so, which is actually pretty comforting if you think about it, that in a time of such high uncertainty, there are these time-tested fundamentals that we can rely on. Those three foundational pillars that we'll talk about are tax-advantaged income, high credit quality, and long-term credit sustainability and resilience. So we'll start with income. For high net worth individuals, and especially for those that pay California's highest state income taxes, municipals are very attractive relative to other fixed income sectors. Comparing equal rating after-tax yields against other sectors like investment-grade corporates, we see that municipals offer income advantages across the entire yield curve, with the most pronounced benefit being in longer maturities at approximately 70 basis points today. We can also look at that income on a risk-adjusted basis by unitizing that down to an income per unit of duration or an income per unit of rate volatility. And when we do that, municipals look even more attractive. We also evaluate it in a historical context. One of the ways we do that is through regression analysis, and it shows that even in this low yield environment, tax-adjusted municipal credit premiums remain attractive historically. Municipals are also one of the last remaining tax-advantaged investments. And let's face it, There is a high degree of uncertainty right now around the future of tax policy and the potential for higher tax rates. So on that front, municipals continue to be an effective haven to preserve present income and a crucial diversifier within a broader fixed income portfolio. The second pillar is credit exposure. Given the current economic backdrop and health-related disruptions, credit has returned front and center. After a decade of narrow dispersion across the municipal universe, we're starting to see that dispersion increase, and that compels us to assess the risk-adjusted metrics of both income and returns through the credit lens. The two primary areas that we'll look at are average credit ratings and historical default rates. When we look at credit ratings, it's clear that municipals carry a higher average rating. And again, we'll pick on investment grade corporates. 90% of the municipal index is rated A or better, compared to just 50% of investment grade corporates. Thinking about it from a more draconian perspective, 50% of corporates are within 3 notches of becoming high yield, compared to just 10% of municipals. Consistent with that theme, municipals also exhibit far lower rates of default. According to Moody's default studies, 10-year cumulative default rates of all investment grade munis are just 10 basis points, which is less than that of AAA rated corporates. We expect this relative credit performance to continue through this environment. And finally, long-term credit sustainability and resilience. The municipal universe presents a unique opportunity to build a diversified portfolio while targeting issuers that are proactively delivering positive social impact missions and addressing long-term sustainability concerns. So to restate, we believe municipals remain an attractive core investment for high net worth clients, providing attractive tax-advantaged income, high credit quality, and long-term credit sustainability and resilience. So I'll hand it off to Ksenia right now to expand a bit on that third pillar and discuss how we think about and define impact investing in municipals.
Thank you, Adam. Well, we highlight municipal bonds to you today in the context of impact investing because, as many of you know, for over a century, municipal bonds have been used by state and local governments and essential service providers to build and maintain our nation's most critical infrastructure, education and health facilities, public safety nets, and other social mission-driven projects. While this is great pasture for socially conscious investors looking to align their investments with their values, it's also a great place for those who associate the consideration of environmental, social, and governance risks in the investment process with higher quality portfolios, lower volatility of returns, and outperformance in the long run, as Adam just mentioned. You will see that our social impact framework combines all of these considerations for a holistic security level approach. One of the first things that I'll clarify for the audience is the difference between ESG factor integration and impact investing. ESG factor integration is just a fancy term for the consideration of environmental, social, and governance risks and opportunities that may be material to long-term financial performance of assets. Integrating these factors alongside conventional financial metrics in your due diligence process should be done across all of your asset classes all of the time. Its cornerstone is financial materiality. Is this an unmitigated risk that can impact credit quality in the near term, or a missed opportunity to get ahead of industry trends and improve financial results? This is the nature of the questions we ask issuers. ESG analysis tends to capture more of the downside risk exposure. It has a top-down application methodology and has more consistency in standardization and measurement and reporting. Impact investing aims to provide comparable financial returns as well as non-financial values-driven benefits. It may include directing capital to projects that will effectively address issues of environmental degradation, socioeconomic inequality, or the need for infrastructure modernization. The latter is the approach we took to construct our municipal impact strategy. So how do we actually go about selecting securities and assessing their impact profile? While our fundamental research process includes the integration of sector-specific ESG factors as part of due diligence, the security selection and the impact strategy actually leans on a bottom-up use of proceeds approach that seeks to align underlying project expenditures with an impact category defined in the green or social bond principles as published by the International Capital Markets Association. To be clear, our impact assessment approach is not an in-house ethical or moral overlay on the portfolio. It is a coherent methodology of project alignment with global consensus frameworks and an in-depth inquiry into governance practices, measurable outcomes, and net benefits to the community. Once we've poked and prodded the issuer in fiscal and budgetary questions and understand their material, environmental, and social risks, we apply the framework to any bond we would normally consider to be a good total return investment. We begin with a clear and detailed understanding of the use of bond proceeds as laid out by the issuer, and whether they align with any of the green or social bond project categories. It's important to note that a bond is eligible for an impact score only if its use of proceeds aligns with one of these categories. We do not try to align municipal sectors as a whole because the variety of projects financed in a given sector is way too great. So we focus on matching actual dollars borrowed to environmental and social benefits for the community. To that end, we expect issuers to quantify outcomes and milestones, or at least adequately describe their intent in their bond documents. And we weight this indicator at 30% of the overall score. The strongest emphasis in our framework is on governance practices, deliberative approach, and transparency in reporting. We see strong governance and risk management practices as essential to our participation in a project because we view an investment as a long-term partnership with the issuer. We want to be in a partnership with those who identify environmental and social risks early, engage the community and the stakeholders about the right approach and best practices, commit financial resources in their budgets, and are transparent and accountable enough about the process to not keep us up at night. And we weighed these indicators at 40% of the overall score. And finally, we ask, did the dollars go further with this project in this community or region or elsewhere? This is our net benefit determination. It prioritizes a narrower set of essential services and basic infrastructure and elevates projects that aim to effectively remedy problems that contribute to a heightened local ESG risk profile. And the net benefit indicator is weighed at 30% of the score. And the final score is actually a numerical expression of a weighted average of the underlying subfactor scores that we interpret as high, moderate, or low social impact score at the project level. And we apply this framework to all investments that we consider for inclusion, which allows us to have one approach to a variety of bonds issued across different sectors and by different issuers. In other words, it makes it easier to compare a green bond from a transportation issuer to a bond issued for a charter school in a low-income community. And only bonds that receive moderate or high score in the framework count toward our commitment to invest a minimum percentage of market value in projects that we believe have positive social and environmental outcomes. The working application of our framework is actually a long set of calibrating questions to help our analysts sharpen the qualitative edges of the analysis and better approximate the variety of disclosure and documents they go through to assign numerical social impact scores. But here we wanted to provide you with a visually palatable example of sample analysis and inputs across factors and subfactors of an individual credit. We hope it gives you some sense of the nature of the information we collect and analyze in the process of the inquiry. Now I'll pass it on to Christian to talk about our portfolio construction process in the fund.
Yeah, thank you, Ksenia, and thank you to everyone for joining us today. I'll start out by addressing a few questions and concerns that we often hear. Then I'll provide some broad context around what the fund looks like and how it compares from a traditional fixed income approach. I'll also discuss how we implement the impact framework that Ksenia just outlined. And finally, I'll conclude with a snapshot of historical performance. Given that some varieties of ESG and impact investing are exclusionary by nature, we are often asked if our social impact strategy results in reduced diversification, considers a more limited investment universe, and/or excludes certain sectors. The short answer to all of these questions is no. Our social impact process is additive rather than exclusionary and focuses on the nature and intensity of impact for each bond issue we evaluate. We do not exclude any sectors or issuers as a starting point. We are also often asked if the overlay of the social impact framework onto the fund is accompanied by higher fees. Again, the answer is no. The incorporation of social impact factors is a part of our comprehensive investment process and not an add-on feature. Accordingly, when we launched our municipal social impact strategy, the associated fee structure was unchanged. Finally, we received some questions regarding the standardization of impact investing. While there is not yet one universal set of standards or ratings for ESG and impact criteria, we are guided by a documented and transparent framework that is based on ICMA's green and social bond principles in order to bolster consistency and reduce subjectivity in our analysis. The fund sits within Lipper's California Intermediate Maturity Muni universe, which paints a category with a wide brush. So I think it's important to touch on what our fund is, what it is not, and what we believe are the key differentiating factors amongst our peers. Within the category, you'll find fund offerings that span the spectrum. Some are exclusively tax exempt. As a subset of that, some funds are strictly non-AMT, while others own AMT subject securities. Some funds have an allocation of taxable securities. Within the taxable component, that could be comprised of treasuries, taxable munis, and/or corporate bonds. The Payden California Municipal Social Impact Fund invests at least 80% of its total assets in municipal securities that are exempt from both federal and California income taxes. We do invest in AMT subject securities, taxable munis, treasuries, and occasionally corporate bonds, but only of the 501c3 variety that we still fundamentally view as municipal credit. Ultimately, we feel that this positions the fund as a tax advantage strategy as opposed to a purely tax-exempt one. As a pooled vehicle, our objective is to optimize tax efficiency across the broadest investor base possible. To that extent, we take the most conservative approach of assuming the maximum federal and California tax rates. So with AMT as an example, if you take a look at the upper right quadrant of slide 9, you'll see that as of the quarter ending June 30th, we held approximately 19% in AMT subject securities. Following the passage of the Tax Cuts and Jobs Act of 2017, the estimated number of AMT subject taxpayers dropped from approximately 5 million in 2017 to an estimated 200,000 per year through the year 2025. So with that in mind, we believe the impact of AMT is currently inconsequential in nature. However, subsequent changes in tax policy will dictate how we evaluate the appropriateness of these securities within the fund. In that same chart, you'll see that we also held approximately 16% of the market value in taxable securities. Viewed through the same tax advantage lens, these taxable holdings are in securities that we believe offer both optimal after-tax yields and more favorable total return prospects. Finally, I just want to clarify and state that while our guidelines allow for up to 20% of the fund's market value to be held in taxable securities, this is by no means a given. The allocation at any point in time will be a function of the relative value landscape, total return prospects, and tax efficiency. So going forward, you can expect that the percentage could fall anywhere within that 20% band. Now, while the aforementioned factors illustrate nuanced differences in portfolio construction, what really differentiates the Payden California Municipal Social Impact Fund from our peers is a documented and quantifiable commitment to our social impact framework. As a basic foundational tenet, the fund is invested so that at least 80% of total assets are in securities that score as moderate or high within the impact framework that Ksenia just outlined. We have found that many funds use language that is much broader and have no specified level of commitment. So as an investor, this assures that the majority of your funds are being invested in projects that affect a real social impact within the state of California. Now, knowing what your funds will be invested in, let's take a closer look at how the strategy is implemented at the portfolio level. The social impact screening runs parallel to traditional portfolio considerations such as fundamental credit quality, term structure, duration, interest rate risk, and valuation metrics. As you can see in the bottom half of slide 9, portfolio holdings continue to be prudently diversified across sectors and the yield curve. In other words, the impact considerations are a core component, but not a primary driver of security selection and investment decisions. Or said another way, we do not sacrifice performance potential for the sake of impact-oriented investments. We believe we do not have to sacrifice performance for the sake of constructing an impact portfolio. In fact, both anecdotal market observations and work and research papers indicate that there is currently no statistical difference in the pricing of municipal green versus non-green bonds. With that said, we do believe there's an element of the proverbial chicken or the egg debate at the heart of impact investing. ESG and social impact factors represent embedded risk factors within our investment universe, thereby making them long-term drivers of credit fundamentals. We believe the associated governance issues and the way that municipalities manage these risk factors will ultimately impact issuers' access to the capital markets and their associated cost of capital that investors demand for borrowing needs. So while there is no statistical advantage or disadvantage at present, we do believe being a first mover in the investor space will create a performance advantage and drive fundamental credit strength that ultimately impacts preservation of capital. Finally, let's take a look at performance. If you reference slide 10, you'll see that within our investment peer group, the Payden California Municipal Social Impact Fund ranks in the top decile over the trailing 1, 3, and 5-year periods. What we are perhaps even more proud of are our risk-adjusted returns. Amongst our investment peers, our Sharpe ratio ranks in the top quartile over trailing 1, 3, 5, and 10-year periods. So what this tells us is that not only has our nominal performance been very strong, but we've been able to generate these returns without incurring excess risk for our investors. So while we obviously can't guarantee future returns and past returns are not indicative of future performance, we do feel very confident in our ability to achieve the fund's core objectives of seeking tax-exempt income and preservation of capital. If you take a look at slide 11, it provides a historical snapshot of our nominal returns, along with risk-adjusted metrics for added context around our peer comparisons. And one final element I'll touch on as it relates to the fund is our size. We believe sizing is an important component to continued strong performance in the future. The fund currently has an NAV of approximately 63 million. We believe our strategy is scalable up to the 500 million range, but we have no intention or desire to become one of the behemoth funds. We believe a large component of performance is our ability to take advantage of market dislocations, something we've done successfully at numerous turning points in the past. However, once you start crossing the billion-dollar threshold, a fund becomes much more closely tied with technical factors that are beyond our control, such as sustained inflow and outflow cycles. We believe in our ability to add value through active management and believe appropriate sizing is key to maintaining our ability to do so. So in summary, the Payden California Municipal Social Impact Fund is a tax-advantaged total return vehicle optimized for California investors. We are one of a few, if not the only product offering with a documented and quantifiable commitment to social impact investing within the California Municipal Fund universe. And while the impact framework is not the primary driver, it is a core component of our risk management discipline, and we believe a core component of our ability to generate strong expected returns in the future through active management. Thanks to everyone in our audience for tuning in today. That concludes our prepared remarks. And at this time, I'll turn it back to Maurice for Q&A. Thank you.
Thank you, Christian. For reference, on the current slide, we have included your dedicated funds team contacts, general team email address, and phone number where you can reach out to receive our municipal commentary and subscribe to our webcast series. We would now like to take your questions. If you have not already, please submit your questions via the Q&A capability at the bottom of your Zoom window. We have a few questions that were sent in during the call. The first question, you've discussed California specifically in the presentation. Can this strategy be implemented outside of the fund and outside of California? And Christian, I'll direct that question to you.
Yeah, sure. Thank you, Maurice. I'm glad this actually came up. So I think there's three primary points that I would address as it relates to this question. The first is that the social impact framework, it can be applied in separately managed accounts as well. You know, we've obviously focused on the fund today, but it can certainly be replicated across separate accounts. It can also be replicated for, in a separate account, either specifically for California or any other state for that matter. And finally, the level of commitment can be customized to any desired level. So if you even wanted to have a 100% commitment to the portfolio, having moderate or high ratings, that's certainly something that we can create for you.
Thank you, Christian. The second question that came in, how is the strategy necessarily different from a full municipal strategy? You've pointed out that the majority of bonds in the municipal universe are effectively impact-oriented in one way or another. And Ksenia, I'll direct that question to you.
Thanks, Maurice. The key difference in the way that we approach the impact strategy really, I think, rests in the security selection process. That's really the driver. The fact that we look down to the project level and we really try to align it with global consensus principles of what impact is or has been defined to be in environmental social space. That's really the key difference. It's the nature and depth of inquiry is much more pronounced in an impact strategy, whereas before when we would construct a portfolio along guidelines, client set guidelines and SMAs and funds around sector diversification, structural diversification, perhaps state quality, and so on. Here in the impact strategy, we really just go to the docs, to the use of proceeds, and see if it aligns with what we're trying to do. You may end up in that process, you just may end up with concentrations that are with lower concentrations in sectors that do not align well, or in use of proceeds that do not align well with social or green bond principles. And some of that, is concentrated in sectors like airports, for example. You'll see fewer of those, although we do consider green airport projects for the fund. And so on. So you might see different bucketing and allocation to sectors, but ultimately it really goes down to how we select securities and the intensity of inquiry around impact characteristics for each individual security.
Thank you, Ksenia. The third question that just came in The history of the social impact strategy within the fund seems to be relatively recent. How long has this fund been launched, and how has this impacted positioning and historical performance? And Adam, I'll direct that to you.
That's a great question. The short answer is that we've been incorporating these impact considerations into our analysis for the past few years now, as we've identified them as crucial inputs into long-term credit performance. And I believe both Ksenia and Christian touched on those throughout the presentation. So, we expect the analysis in the input into the selection process to really contribute positively to our selection. And so while the formal change happened in February, where we did relaunch the name, it's really been a gradual process, right, as to how this has been incorporated. And it was really our recognition of these as inputs into the analysis process, but also a trend in the marketplace. So, when that launch did happen in February, there was not a material reshifting of the portfolio. It has been a much more gradual process than that. So I believe that the performance of this strategy is well indicative beyond just the February change.
Thank you, Adam. As we're getting close to the half-an-hour mark, that'll conclude our Q&A for today. There were a number of additional questions that came in that we will address directly by email following the presentation. As mentioned, the recording will be available on the Payden site and also emailed directly. We thank you again for joining us today, and we look forward to having you at our next webcast.